E.L. Bruce should have made him eager and less cautious, yet somehow it made him more cautious. He'd made over $325,000 in 9 months investment. He was determined not to lose it by a wrong move. So many operators have made big money in 9 months and lost it in 9 weeks. He decided this would not happen to him. Overconfidence has been detected among many professionals by both psychologists and economists. This leads to higher turnover and deeper losses. The first step he took was to withdraw half of his profits from the market. With his remaining capital, he eyed the market warily. He cautiously bought 500 shares of molybdenum. He had bought it at $27, paying $13,606.25 for the total position. Almost immediately, he was stopped out at $26.5. He'd clawed back $13,132.78. Remember the research by UC Berkeley professor Terence O'Dean? It shows that investors lose because they tend to cut their winners short and hang on to their losers. Nicolas does the exact opposite. His system cuts losing positions short and hangs on to winners. He buys 500 shares of Havag Industries at 31 3/8. He pays $15,860.25. It turned around and looked as if it was going to slip under $30, so he sold out at 30 1/2 for $15,056.94. This is a 5.06% loss. Then, as he saw nothing interesting, he ventured back into Lorillard. This stock had now become a weary, slow-moving obesity. It became his American pet. This was an utterly wrong attitude, but he couldn't seem to help it. This is how the Lorillard operation looked. He scales in 3 times for a total loss of $6,472.53. That did it. The third loss finally broke his sentimental attachment, and he did not buy it again. He realized that Lorillard now moved at a very leisurely pace. It was obviously no longer a stock for him. After he withdrew from Lorillard, he sat back and assessed his overall position. It looked like this. He now held 5 stocks: Lorillard, Dinners Club, E.L. Bruce, Molybdenum, and Havag Industries. Among the stocks that caught his eye was a little unknown company called Universal Products. It was quoted around $35, running up and down between 35 7/8 and 33 1/2. He found out it was an electronics company, and therefore he felt it qualified as far as his techno-fundamentalist theory was concerned. In July of 1958, he felt he could get a better feel of the stock's movement if he actually owned some of it. He decided to make a pilot buy. He sent out the following cable: buy 300 Universal Products at 35 1/4 or better. Next day, when he received advice that 300 shares of Universal Products had been bought for him at 35 1/4, he wired enter stop loss 32 1/2. Now there was nothing to do but sit back, watch, and wait for the next move. His side rule: do nothing. In August of 1958, he notices that Universal Products is beginning to firm up. He cables buy 1,200 Universal Products, 36 1/2 on stop, 33 stop loss. This represents a 9.59% stop loss. Do you notice a pattern in the percentage width of his stop losses? When he returned to the Imperial Hotel in New Delhi, he received the notice: bought 1,200 U 36 1/2, 35 7/8, 35 1/8, etc. This meant that he bought his stock at 36 1/2 and it closed at 36 3/4 on average. Now the question was, will his stock advance or will it return to the former box? He was quite excited. Although he'd already fixed the amount of his possible loss, now it was a question of whether his judgment was right or wrong. He could hardly wait for the next day's cable. When it finally arrived, it showed that Universal Products had closed at 38 1/8. Its range for the day was 38 3/4, 37 1/2. The price was clearly running upward. He was right for the time being. In the next few days, the stock continued to advance, and he bought another 1,500 shares at $40. Shortly thereafter, Universal Products changed its name to Universal Controls and split 2 for 1. It continued to act well after his last purchase. He decided that he'd had as much universal controls as he cared to carry. Notice that Darvas is running a small collection of stocks. This is called a portfolio. Some common portfolio possibilities are 500, 30, 10 stock, 5 stock, and 3 or fewer stock portfolios. This was his exact position with prices averaged. He now controlled 6,000 shares with the split. Nicolas Darvas's secretary did not have the courage to buy universal controls. The personal secretary's father advises his son, "What is the point of buying a stock if it might go down?" While his father was engrossed in careful examination of the books, fundamental analysis, the stock went up to $50. In February of 1958, the stock had just split 2-for-1 and was the object of heavy trading in terms of volume, before it quieted down into a 39.47 box. It stayed calm in this area for several months. He had the feeling that it was a calm that precedes a storm, and in fact, in March, he cables, quote, Thiokol. The quotes duly arrived, but except for a few weeks of short-lived flurry in April, nothing noteworthy happened. After a week, he cables, stop Thiokol, quote, start quoting again if rises over 45. He reasoned that if it reached again toward the upper frame of its box, that would be the moment to watch it again. In the first week of August, Thiokol starts to reappear in his telegrams. Now above $45, it looked as though it was flexing its muscles for an upward jump. He decided for a pilot buy and cabled, buy 200 Thiokol, 47 1/4. The order was executed at this price for a cost of $9,532.26. 3 weeks is how long it took for Thiokol to find its true dynamics. This is a famous explosion that occurred at a Thiokol chemical processing plant. At the end of August, he felt the moment had come. He cables, buy 1,300 Thiokol, 49 1/2 on stop. The purchase was executed at 49 7/8 on September 2nd, 1958 for $65,408.72. With his 1,500 shares, he saw the stock rapidly rising over 50 and trading in the range of 52.56. A week later, he receives notice that Thiokol had decided to issue stock rights. These rights, warrants, were given as bonuses to the holders of the stock at the rate of 1 right per share. In turn, with 12 of these rights, you could buy 1 share of Thiokol at the special price of $42. The stock was quoted over $50. This was cheap indeed if you wanted to exercise your stock rights. If not, you could sell them on the American Stock Exchange where they were listed and traded for a limited period. Rights are equal to warrants, which is approximately equal to a call option. This is the pit of the CBOE here today. However, there was an important feature about these rights that made them very interesting. According to stock exchange rules, if the rights were being used to purchase the company's stock, he could take advantage of what they called a special subscription account. The broker was permitted to lend him up to 75% of the current market value of the stock. In addition, there was no commission charged on the purchase. He decided to plunge in with all his free cash. Today, high leverage is obtained through the Chicago Board Options Exchange. Call options are far superior to the rights Darvas purchased. Many levels of strikes allow you to modulate the intensity of leverage. Nicolas did not have this luxury. Here is how he stood. He discovered that despite the regulation permitting a 75% loan, that there was wide disagreement among brokers concerning the amount he could borrow from them in a special subscription account. While one broker was willing to lend 75% of the purchase price of the stock, another was willing to advance a full 75% of the market value of the stock. Thiokol was being quoted around $55. The latter proposition was extraordinarily attractive. They'll loan him $123,750. He proceeded to take advantage of it. He buys 36,000 rights at an average price of 1 5/16, for which he paid $49,410. This entitled him to buy 3,000 Thiokol at $42 per share. This would have otherwise cost him $126,000 because 3,000 times $42 is $126,000. But under the rights subscription, he only had to add another 6,000 cash. He figured he could sell his original lot of 1,500 Thiokol shares and buy back twice as much under the special subscription rules. He sold his stock at an average price of 53 1/2. This gave him buying power of $60,187.50. The difference is due to fees. With this, he buys a second block of 36,000 rights, which he converts into a second block of 3,000 shares. An important article by 2 major state university finance professors shows that the highest expected returns are from deep-in-the-money calls. Second are puts. The difference in expected returns is huge. Deep in the money calls and momentum stocks are the best option investments. Long calls are most like the rights that Nicolas Darvas used to trade. According to this research right here in the Journal of Finance, the deep in the money call has the least lottery-like payoffs and has the most protection. The operation looked like this. Sold 1,500 shares of Thiokol stock, bought 36,000 Thiokol rights, converted 3,000 shares of Thiokol stock. He does this in 2 blocks of 36,000 rights. His total value of 6,000 shares was $820,000. In the second week of December, Thiokol shifted from the American to the New York Stock Exchange. It immediately moves up 8 points, dollars that is, and the following week was touching the 100 mark. The broker becomes nervous and telegraphs, your Thiokol profit's now $250,000. He now had over $500,000. This was much more money, in fact, than he ever thought he would have. It would make him a rich man for life. The realization that he had all this money came to him with startling sadness. Every fiber in his being seemed to be saying, sell, sell. It was the biggest temptation in the world. What should he do? Would the stock rise higher, or should he take his profit and get out? Perhaps it wouldn't rise any higher. There might be a fallback. It was a terrible dilemma. The old one of when to sell was much magnified because of the large amount of money at stake created. It was a terrible dilemma. The old dilemma of when to sell was much magnified because of the large amount of money at stake. Leverage from rights also increased the possibility of a total loss. If he did the right thing here, it would change his whole life. If he made the wrong move, he would regret it forever. He felt very alone. Nobody on earth could give him any advice on what to do in this situation. He decided to go out and have a few drinks by himself and consider the situation. Before he went out, he sat down at his dressing table and wrote on a little card, "Remember Bruce?" He thought this would remind him of what he had learned in the past. Every time he felt like sending a cable to his brokers telling them to sell Thiokol, he pulled out his card, looked at it, and hesitated. Finally, he decided not to sell. It was the best example of his new market technique, and it was anything but easy to do. By the time he arrived back at his hotel, he was exhausted. He must have looked more like a man about to commit suicide than one who had just made himself a small fortune. Thiokol continued to rise, and by making that decision in Paris, he was able to hold on and make much more money out of the stock. A few weeks later, in January 1959, he was holding 6,000 Thiokol and 6,000 Universal Controls. They were doing very well indeed. Thiokol was standing on the 100 mark, and Universal Controls had risen to $45. How little did he know that he was preparing to make a complete fool out of himself. Within the next few weeks, he would bring himself within whistling distance of ruin.